So, what does this actually accomplish? In theory, the idea is to starve the fossil fuel industry of capital that it needs to construct new infrastructure. The reality, however, could be a little bit different, right? So, if a group of institutional investors sells off their existing stake in a coal or oil company and they pledge not to buy new issuances, um, what do you think happens? So, what is likely to happen is that someone else who by default cares less about climate change because they are now buying news, or they're buying stock or bonds that have been issued by fossil fuel companies buys it, right? And so that's worth keeping in mind because remember, shareholders have some power, right? Shareholders can help decide the direction of a company, and it's not necessarily the greatest idea to give away power or control of fossil fuel companies to investors who actually don't care about climate change. I've actually heard a couple people saying this isn't a realistic idea, but that the most straightforward way to sort of limit the amount of fossil fuel reserves that are taken out of the ground is for environmentalists to buy all the stock and bonds of fossil fuel companies and then just purposely take a loss, right? To own the companies and then essentially destroy the companies, right? That would be the most straightforward way of accomplishing our goals potentially. Um, the other problem is that institutional investors by default tend not to invest much money in one place. So we can look in particular at university endowments here. On the left, you have U.S. university endowments, and on the right, the university endowments in the United Kingdom. And so this is, I think, representing sort of the typical endowment for these different types of universities. And what you see here is that the typical university invests a very small amount of its overall portfolio in fossil fuel assets. And what that means is that divestment by a limited number of institutional investors is not likely to affect the equity or debt valuations of fossil fuel companies. Though coal companies are probably more vulnerable than oil and gas for a couple of different reasons. In order to really starve fossil fuel companies of the capital that they need, it would take a coordinated global effort among investors. And then, if we're going to do that, right, if we're going to the trouble of, um, you know, pooling together and coordinating a divestment movement across the entire globe, why not just implement a carbon tax? In fact, a carbon tax, even the threat of a carbon tax, actually could spur significant divestment. So let's say you're in the coal mining business and you want to borrow some money to finance the construction of a new mine. And there is a newly elected U.S. President who pledges to, or pledged during the campaign to enact a carbon tax. So basically, any Democratic candidate who's hoping to be elected in 2020. So what happens when the coal company tries to raise that money? So they issue bonds, right? Or they try to issue new stock. So the answer might not be a strict no at this point, but the cost of borrowing is likely to go way up because investors would perceive there to be additional risk involved in constructing a new mine in a political environment that is increasingly adversarial to carbon as a pollutant. And so this gets back to our discussion of debt financing. When companies need to raise money, the interest rate that they're going to pay on the money that they borrow is a reflection of the market rate, but also the credit rating of these companies. And a lot of times that's sort of a historical look at a company's ability to pay bills on time, right? However, if a credit rating agency or investors were more forward looking and they were looking out into the future about what sources of uncertainty might impact probability of debt default. In other words, the probability that the borrower, in this case, a coal company, would not be able to pay its money back. They might get a little spooked by the idea of there being a sitting U.S. president who is very invested in enacting a carbon tax, right? So the rating agencies and investors might require a higher interest rate on the money that's borrowed by the coal company. Same thing with equity financing, right? So if a coal company wanted to issue stock, issue new stock in order to raise money, investors are going to require some sort of rate of return on that. And remember, the return on equity associated with owning stock is typically higher, or in theory should be higher than bonds, because there's just more risk involved in owning the stock of a company than owning the bonds of a company. But there is a similar risk versus reward trade-off when trying to figure out what the price of stock should be, right? So this shows an illustration of what's called the capital asset pricing model, or CAPM. And so you have some measure of risk on the x-axis, and you could think about that as the standard deviation or variance in stock prices or rate of return. And then on the y-axis, you have the expected rate of return or profits. And so the yellow dotted line at the bottom shows the risk-free rate of return, right? So this is the percentage sort of profits you could make by buying bonds from the US government, right? So in a lot of respects, we consider investing in or buying US Treasury bonds to be risk-free, which means there's a 0% chance that the US government's not going to pay the money it borrows back to investors. And so you can earn some sort of rate of return at that level on the y-axis that has no risk associated with it. But if you want to earn any higher level of profit, then that's going to involve higher risk, right? And so the same thing is true if you're, a coal company and you're increasingly viewed as a risky investment. Your shareholders are going to expect a higher rate of return in exchange. And so what that means is that risk makes it more expensive for fossil fuel companies to build new infrastructure. And the risk of carbon legislation is increasingly being viewed as a serious risk for fossil fuel companies. This also raises another possibility, which is that investors should not necessarily, institutional investors should not necessarily divest in order to force action on climate change, right? But rather to limit their own exposure if and when that action comes. So if you're a university endowment, you may face increasing pressure from the student body to essentially put your money where your mouth is. But another way to think about this is that actually, if university endowments were worried about over the long term building wealth for the university, they might want to increasingly start thinking about the possibility that if there is some sort of global action on climate change that results in significant fossil fuel reserves being kept underground, that actually that represents a financial risk, right? If you are, an investor in a fossil fuel company, the day after we globally decide to keep 80% of coal under the ground and 50% of natural gas and 33% of oil, it's likely that the day after that happens, the value of the stock you owned in those fossil fuel companies and even the value of the bonds that you own is significantly lower. In other words, we may reach a point in history where investing in fossil fuels, for example, buying bonds or buying stock in a company, it could be viewed as an increasingly foolish investment, not because those fossil fuels are inherently not valuable, but because there may be political action that makes those fossil fuels lose value, and that would be related to widespread coordinated efforts to mitigate carbon dioxide emissions in an attempt to rein in the worst effects of climate change. So again, if you're a university endowment, right, and there's a portion of your investment portfolio that's tied up in fossil fuel assets, for example, you have to start thinking at this point about what would a carbon tax potentially do to the value of the fossil fuel assets that you've invested in, right? We talked about in the context of a carbon tax, the whole point really is to make the burning of fossil fuels more expensive in order to encourage people to switch away from fossil fuels. So if people are switching away from fossil fuels, that's sort of this implication that the value of fossil fuel assets, right? The reserves, the coal that's under the ground, but also the infrastructure that's used to mine that coal, to refine it, to transport it to where it needs to be used, the power plants that actually burn the fossil fuels, those would all become inherently less valuable. And so we're going to talk more about this a bit next time. In the meantime, what I want you to do is consider some discussion questions, right? Especially in your role as a student at NC State, right? You may know or have colleagues that are interested in encouraging the NC State endowment to divest from fossil fuels, and they may be engaged in trying to convince the university to do this. So some questions that I think are relevant are, why do this? Why should NC State divest from fossil fuels? From the perspective of the university, what's the responsibility of the university and the managers of the university endowment in making this decision? How could the university's decision to divest in fossil fuels potentially affect you as a student? Would you be willing to support this? Right? You may have colleagues or friends that are asking you to sign something showing your support. And what about your peers? Is this something that you think your peers would support, or would they dismiss this as either harmful or ineffective? Okay, next time we're going to talk about stranded carbon assets, and the final homework, number 9, has been assigned.